The read now from Market Lashini and Michelle McKinnon. Michelle, is this, an overstatement on the part of the markets? I mean, we see this great story in the Wall Street Journal today about we're not buying on the dips anymore. And I'm wondering, every time this happens, that seems to be the case.
I mean, I think we need to take a step back and recognize that it's only been a couple of months since we were at all-time highs. So, Neil, I have to say I'm actually still a buyer here. I've been a buyer for a while now because the fundamentals just keep getting better and better in regards to we have lower prices and we still have strong earnings. So I know there's a lot of noise out there, but normally the best buys come in the darkest hour.
All right, so this is maybe the darkest hour and not likely to get darker. What are your thoughts on that, Mark?
Not all that dissimilar, actually, Neil. I mean, you mentioned it. I think what we needed to see was a washout of that buy-the-dip mentality that was holding the market in. We needed a capitulation bottom to be realized. I'm not sure that we've necessarily seen all of it yet, but the point is we're probably getting closer to it than not. And otherwise, I still believe that the fundamentals do support a better case for equities. We've seen a derating in the market multiple to a level that pretty much discounts a much more sober view of the risk that you mentioned, all of which are legitimate, all of which haven't yet been resolved, and therefore will likely to continue to put pressure on the market. But nonetheless, I think that's being baked in increasingly so at this juncture that perhaps we're sooner to finding a durable bottom than not at this point.
I don't see, and to both of your points there, the brave souls willing to say, all right, this is a good time for me to jump in. They might materialize, and they, there was certainly hand-wringing last week for a while. We were down about 800 points on that particular day, thanks to some sentiment building that the Federal Reserve is going to be slow to raise interest rates. We paired almost all of those losses, only to fall later on in the week. I'm wondering what you see really going on here, Michelle. I mean, if individual investors get to the point where they say, oh, the heck with it, then what?
Heck with it to buy or heck with it to sell?
The heck with the market, period.
Okay, well, I think as long as you're appropriately allocated, right, all my clients, for the most part, have a good portion in bonds, and actually bonds have been positive the past few weeks. And also, Neil, which has not gotten a lot of attention, is emerging markets have not gotten hit nearly as bad, as well as commodities, right? So if you're in a diversified portfolio, you're not down 4 to 5%, and you can be a buyer. And I think it just comes back to, are you a long-term investor? Or are you a short-term investor? Short-term, I mean, your guess is as good as mine, but long-term, I would definitely be a buyer here.
Mark, I also looked at sort of the underpinnings of this market and noticing that technology stocks are still getting hit hard. Apple, for a separate set of reasons we'll explore a little bit later in this broadcast. But this notion that technology can't seem to get out of its own way has been roiling these groups and defanging all the FANG stocks and continuing to do so. To the point now where only 18% of money managers are at this point committed to technology. What happened?
Well, it's interesting. It became a very crowded trade that's being unwound at this point, Neil. I mean, we not only know that before the new communication services sector was launched, technology as a component of the S&P 500 was a 26% weighting. And therefore, a lot of funds, a lot of ETFs that are tied or proxy either to the market or the QQQs or anything that was overweight momentum stocks, which were being led in many cases by a 40 to 50% weight in technology, is now being hit with a keystroke. And as a consequence, these same funds are having to purge what they own most of, which is helping to amplify the impact it's having on the technology space at large. It's indiscriminate at the moment. We're constructive on software technology, which continues to realize benefits from business CapEx, which is still expanding and disproportionately spends more money than not on software technology. And therefore, those stocks should ultimately benefit from that as we continue to think the fundamentals are good for the economy out over at least the next 12 to 18 months or so. But in the meantime, one has to live with the fact that they're also sitting side by side with the semi stocks and the hardware stocks that are getting clobbered, and maybe in some cases deservedly so because their valuations were ripe for the vulnerabilities that we're now seeing these stocks experience.
Guys, I want to thank you both very, very much.